We're keeping a close eye on yields today with the 10-year up about 5 basis points. But watch the 30-year about 4.799. We're going to get a key auction result in just a couple of moments. We also have Fed Chair Powell's speech today at 2 p.m. Eastern. And this morning, more signs the labor market is cooling. Continuing jobless claims climbing for the 7th straight week, highest level since April, while the monthly average for initial claims rose to just over 212. How should investors balance the data with the Treasury supply that markets also have to digest? Let's bring in Mark Smith, Senior Vice President and Portfolio Manager at Wells Fargo Advisors, and Senior Economics Reporter Steve Leisman. It's good to see you both. Steve, let's just start with you as we wait for those full 30-year results. How much of the upward pressure on bonds goes back to the deficit?
I mean, a good portion of it. I'm informed by the survey we did, the recent CNBC Fed survey, and basically it was a third. A third what? Well, a third growth, a third of the issuance, and a third of the Fed hawkishness or the rhetoric from the Federal Reserve and their more hawkish outlook in terms of taking away cuts next year. I think those were three parts of it. And I think what's happened is a couple of those have gotten under control, at least short term. The growth looks like there's a little bit of a weakness in some of the data we've had recently. The Treasury announced a refunding announcement that was more in line with the market's ability to basically stomach, and we'll hear more about that in just a few seconds, I assume. And then the Fed has eased off a little bit. The trouble with the issuance question is when you look at the deficit and the numbers announced or made more final by the CBO yesterday, the issuance problem isn't going away. You have long-term structural pressure on the federal deficit. You look at how we got to this $1.1 trillion over 2022 to a $1.7 to $2 trillion debt budget. Well, there was interest expense was a big part of it. That's not going away, Kelly. In fact, I think that's going to go higher. There was more pressure, Social Security, from COLA increases. There was some more pressure on spending. That was not the biggest part. The biggest part was the decrease in revenues. That may come back this year, bring the deficit down, but long-term higher deficits are definitely in the cards.
All right. And Mark, a comment from you.
Yeah, listen, when you're looking at how you're looking at where the Fed's going to be going, as you said, Powell's talking about an hour, you have to look at one of the most hawkish Fed chairs, which is Kashkari out of Minneapolis. And he said yesterday that, they're really focused on core CPE. It's a record that kind of looks about how the consumer's doing. And it was at 2.5% on the 3-month, which is lower than the 6 and the 1 year. So it's in a good direction. They thought that was the best news that they've seen in a while. And, they're really looking to see if that ticks back up. If it does, it looks like that he's going to be for higher rates. And I think that you might have other folks in the Fed agree with him.